But is this a good time to put money to work, or there is still a lot of froth in the system and valuations they need to correct before markets they look attractive? So let's talk about market valuation, themes and ideas with Pankaj Murarka, Head of Equity with Axis Mutual Funds. Pankaj, good morning and thank you for joining us. Well, I guess my introduction was the question in itself. Do you think it's a good time to put money to work, or markets they need to correct more?
Oh, I think it's a phenomenally good time to invest into markets. Any correction should be a great opportunity to invest. From a valuation perspective, markets are still very reasonably priced. They're trading at about long-term averages, about 15 times forward earnings, which is where our markets have traditionally traded. And we've always seen that whenever you see an acceleration in growth and an acceleration in earnings growth, Indian markets tend to trade 1 to 2 standard deviation above mean. So there is significant upside even on valuations by themselves. So I think any corrections or pullbacks in the market should be a great opportunity to buy into these markets from a medium-term to long-term perspective.
So where are you overweight or underweight on respectively? What have you bought and sold over the last 3 months from a sector perspective?
So we are fairly constructive on all the domestic cyclicals. We firmly believe that the domestic economy has clearly bottomed out and should gradually recover as we get back to 7% kind of a growth trajectory, probably in 8 to 10 quarters from here on. We think domestic cyclicals will be the biggest beneficiaries of that. They've been the most impacted because of the slowdown in the domestic economy over the last 4 years. So we remain very constructive on the domestic cyclicals and we continue to remain overweight on them. Also, financials is another sector which we like quite a bit because we think that will be the biggest beneficiary of the recovery in the domestic economy. So we continue to remain overweight financials as well.
Within financials, where is the tilt? Are you looking at private banks or have you been accumulating in building positions in PSUs as well, and also NBFCs?
So we've always liked private sector banks because we think they are very solid franchises and they have done an incredibly good job in managing asset quality or the risk of their balance sheets in the last downturn. But of late, over the last few quarters, we have bought into state-owned financials as well because we think they've been the most hit by the slowdown in the domestic economy over the last few years, and they've taken it on their chin. As we see recovery in domestic economy and many of the stalled projects get going, they will benefit from that as well. Also, their valuations have reached a point where they offer good value to a long-term investor. So we have bought into state-owned financials over the last few quarters.
Cyclicals and financials, pretty much across the board, that's a consensus buy. Everyone is bullish on cyclicals and financials. Are you not worried about this consensus opinion? Because the consensus really gets it right. For the moment, not 8 on 10, but 9 on 10, 10 on 10 market participants are bullish on financials and cyclicals.
Not really, because I believe we are in a very early stage of our growth cycle. Our growth, if you see, has actually halved from 9% where it used to be in 2007-8 to where we are today at about 4.5%. If this government executes the mandate which they have been given, then there is every reason we can go back to similar kind of a high growth of 8-9% in probably 5 years time from here on. And if you think in that context, then I think we are still in a very early stage of growth revival of growth recovery. And as we try to put back our investment cycle back on track, which has been completely broken, then companies within these sectors will reap the benefits of that.
But where will that money come from? Because ultimately to kickstart a new economic cycle, you need fresh capital commitment. Corporate India has an extended balance sheet. Government of India, the balance sheet is stretched. They have to focus on fiscal. So my question to you, Pankaj, is that what really will kickstart the new investment cycle which everybody is betting on?
I think the most important thing is policy clarity. If we get policy clarity and if we get a long-term policy making right where there is consistency in policy, capital will just flow in. There is no constraint on capital, both domestic and foreign. Probably foreign capital flows to India can be far higher than what we have the ability to digest. So I don't see capital as a constraint. I think it's more about getting a policy clarity and getting execution on policies right.
Anything that you have picked up among the less talked about sectors? There was of course all that talk about agri-related themes doing well in the market. Anything that you have gone overweight on, bought which is contrary and less talked about?
So we do have some exposure to some of these sectors like agrochem, because we think again that can be a great opportunity as for India to emerge as a big exporter on the agrichem side. So that's pretty exciting, and we have some exposure to that. We continue to remain constructive on IT and healthcare. They've been delivering consistent and very solid numbers. The underlying businesses still continues to grow at a very robust pace. So we continue to like those sectors and we continue to own them. We have continued to own select consumer stocks where valuations we think are reasonable and the growth is still strong. So we have exposure to all of these sectors.
Are you a bit surprised with the underlying strength what metal stocks have exhibited? Hindalco this year is up more than 50-60%, ditto for Tata Steel, and now other non-ferrous stocks are also giving company to Hindalco. Do you think metals have genuinely bottomed out and that could be the story and the theme for the second half of this year?
So well, they were beaten down equally sharply, and what we've seen a bounce from the lows. These companies were significantly impacted because a lot of their projects were stalled. So clearly there is expectations that with the new government we've already seen clearances for some of their projects. So and they had a significant amount of their capital locked in projects which were stalled. So as that projects as those projects get executed, these companies will clearly be beneficiary of that. Also, probably I think there were some fears out of significant softness in Chinese economy, but it seems from the data that's coming out that it seems that the economy is holding on, and China probably will do closer to 7.5% growth there or thereabout. So I think, and also we're seeing some recovery in the Western world as well. So I think it's a mix of all which is leading to some strength in these stocks.
I don't see too much of cement in the portfolios you manage. Consciously have you decided to give cement a skip?
Well, our view is that the valuations in the sector are very rich. So while growth prospects are strong for the sector, but we find valuations as a constraint, and we think valuations are very rich in the sector. So we are underweight the sector.
Among cyclicals, especially infrastructure, which is the pocket that you're most bullish on?
So we like autos and auto ancillaries because we think India probably will emerge as the fastest growing auto market globally, and we'll see a significant improvement in the volumes for most of the auto companies because there is a significant amount of pent up demand which has been held back in the system for the last couple of years. As we see consumer confidence coming back, we'll see significant uptick in demand for autos across the board, and we think this sector will be a big beneficiary of that. Also, we like the engineering and the capital goods sector because most of these companies have been hit badly because of the slowdown that we've seen in the last 3 or 4 years. And as we see recovery in the economy, I think they'll again be one of the biggest beneficiary of that.
So Pankaj, for someone who's searching or hunting for value in a otherwise overinflated market, where is value in this market?
Well, while markets have run up pretty sharply from a last 6 months perspective, but I still think valuations in these markets are very reasonable. As I said, they are somewhere trading near mean valuations. So I see significant amount of value from a medium-term perspective across sectors. I don't see this market as by any data point that I look at being overvalued or being expensive on any metrics. So I think in the context of the fact that we are still at the low point of our growth, and as growth recovers, there's significant amount of operating leverage that exists in most of the sectors. Many of the companies across sectors are operating at 60-70% of their capacity. So as these capacities get utilized, there will be a significant amount of operating leverage that will kick in. So in context of that, our view remains very constructive on the whole of manufacturing sector.
All right, Pankaj, we leave it at that. Thanks very much.